Markets this morning quiet on this Friday morning. Take a look. The Dow Industrials right now down about 8 points. The S&P lower by 1.25. But the Nasdaq continues gaining. It's up another 25 today after gains yesterday. The S&P 500 and the Dow were lower yesterday, but the Nasdaq ended higher. Pretty good move in the Nasdaq, up 121 points at the close. Markets reacting this week to the Federal Reserve's commentary on inflation. The central bank raising expectations, also projecting 2 increases in interest rates by the end of 2023. Most market participants expect the tightening and the interest rate hikes to begin next year. Joining me right now is Lebenthal Global Advisors President Dominick Tavella. Also joining the conversation all morning long this morning, the Wall Street Journal's Assistant Editorial Page Editor, James Freeman, is here. Payne Capital Management President and Payne's Points of Wealth podcast host, Ryan Payne, is here. Great to see everybody this morning. Thank you so much for being here. Dominick Tavella, kicking things off with you after a week that we may very well have begun this tightening conversation. What are your thoughts on what you heard from the Federal Reserve, and do you change the way you allocate capital now that we are looking at interest rates supposedly going up perhaps next year?
Well, think about this, Maria, and you brought up 2 key points. The first is they moved up their expectations for inflation from a 2+ to 3+%, and they obviously increased their expectations for increasing interest rates earlier than they originally had told us. So under that environment, higher interest rates, you would think the 10-year yield would have gone up. It actually went down. You would think inflation, commodity prices would go up. They actually went down. You'd look at bank stocks, where higher interest rates really benefit bank stocks. They went down 3%. And growth stocks, large cap growth stocks, the enemy is higher interest rates. That actually went up yesterday, almost the exact opposite of what you would expect based on the Fed announcement. So the market's really struggling trying to interpret here what the Fed is going to do and when it's going to do it. And obviously, when is inflation really going to hit and how hard is it going to hit?
Yeah, I mean, look, you've got 2 different scenarios here. Ryan Payne, jump in here, because do I believe the Federal Reserve that inflation is going to be at higher levels over the near term and that interest rates are eventually going higher? Or do I believe the bond market, where the 10-year is down again this morning? I mean, what a reaction from 10-year investors, sending prices up and yields down. Look at the yield on the 10-year right now. It is down 2 basis points at 1.488%, Ryan, even on a day following a week that the Federal Reserve said rates are going higher. They're going lower.
It's shocking, right? But I have to say, do I believe my lying eyes? And my lying eyes tell me that inflation is real. Right. I took an Uber today to my office. It was double the cost it normally cost. You just go to the food store right now, gasoline prices. So, I think the bond market, I think commodity prices have cooled off a little bit, but I suspect that the Fed might be wrong here, and inflation isn't transitory as they're making it seem to believe. I just see prices going up everywhere. I don't think that trend's going away. And let's face it, the 10-year Treasury has come from 0.5% last year. So we've had our big move up already, so maybe it's just a little respite. But longer term, I still see interest rates going up, and I have to think inflation here is here to stay. It's not transitory like the Fed's telling you.
Dominick, what do you make of the moves in the bond market? Why are yields down?
So Professor Siegel Wharton really thinks the Fed's got this one wrong. He's talking that we could look at 5% plus a year for the next 4 years, a 20% increase in inflation over the next 3-4 years. So he really adamantly thinks that the Fed's got this one wrong. Now, we've seen lumber prices roll over. We've seen copper prices roll over. Commodities have really come off their highs. So there is this feeling right now in the markets that maybe inflation is not going to be as bad as some expect it to be. I don't know. I'm looking at the Fed, and I'm thinking they're taking their eye off the ball. They're not focusing as much on inflation as they are on employment. I think they keep interest rates lower for a longer period of time. That's why value stocks are going down and growth stocks are going higher. But I think they're going to get this one wrong. Now, it may not be the 80s. It may not be double-digit inflation. But could I see embedded 3, 4, 5% inflation a year over the next couple of years? I think that's reasonable, Maria.
Do you still want to own then growth stocks? Do you change the way you allocate capital based on what you heard or based on your believing the Fed is getting it wrong?
So I've been speaking with you all year long, and I've been a big fan of this market. We've been pretty aggressive in allocating cash to equities. We actually did our first sale yesterday. We took 2.5% off of our large cap growth sector. I think you need to be very disciplined here and take some profits, bank some money, get ready for this pullback. I think we're starting it right now. And then I think you buy some of these things that are going to come off. And bank stocks, I think, are a terrific place to be through the rest of this year. I love international. I see what's going on in Europe, and it's starting to open the doors and grow. So I think you need to be very disciplined, harvest some profits, bank some money right now, put it on the sidelines, and then buy aggressively when you see this dip coming up.
Well, I'll tell you one thing, James Freeman, real quick, we're going into a period where we're about to see a string of dividend increases for the banks. Once you get through those stress tests, you're talking about really the floodgates opening. We had Brian Moynihan. He said it's likely we'll raise our dividend, likely we'll buy back stock when we're allowed to. So that could be a catalyst for the bank stocks as well come August. What do you think, James?
Yeah, I think they will be returning more capital to shareholders, but I would worry about for them and all stocks. What is the real return going to be on stocks going forward, the after inflation return? And we're still looking in any scenario at a very accommodative Fed for the next few years. And I don't have as much confidence as I think those 10-year bond investors do on their wisdom and ability to restrain inflation, or desire to, for that matter.
Yeah, interesting that you guys are all on the same page in terms of looking at the Fed skeptically here, whether or not they're getting this right. Dominick, good to see you. Have a great weekend. Thanks very much for weighing in this morning. Always a pleasure.